Off, and it seems to me that we are live. I'm recording from the studio here in Melbourne today, and our special guest for this evening will be joining us from someplace much far greater, far warmer than it is here in Melbourne today. It's a cool few degrees, I would say, outside. So we'll be warmed up with some ETF and some macroeconomic talk in a little while, and I'm excited because it's not every week we get to speak to someone, as you will find out tonight, David Bassanese from Betashares, who can speak to investing in ETFs across the whole spectrum. So we're going to kind of dig into that and dig into how he thinks about long-term investing, particularly in times when the market seems so uncertain. For example, today we saw that the stock market fell 1.5%, not to make it too myopic or too short-term, and I saw that Mike put in the comments, what happened to the stock market today? And I think a lot of us become so fixated on the short term that it's good to orient ourselves back to the long term. So I will be sharing my screen. I've got a few slides. In the second half of the program, we'll be talking about some of the mental tricks and, I guess, traps that we can fall into and how to solve them when it comes to long-term investing. And as always, I like to start with a bit of a joke. So I'm just going to get that up on my screen here. I know this is the second most important slide of the evening, so I will get to the most important in just a moment. But my joke for this week is as follows. 5 ants rented an apartment with another 5 ants. Now they're tenants. And that is my joke for this evening. Give us a score out of 10. I think it's actually pretty good. It's probably the only one in the last few years that's actually made any sense that I've shared with y'all. So hopefully you enjoy it. But let us know. I can see Amrit's joined us over on LinkedIn. G'day, mate. Fantastic. Thanks for joining us. A reasonable groan, says Rob, with a 7 out of 10. Danica gives me a 10. Benny, a classy 8.5. Thank you so much. Okay, so let's get on with the bit that everyone, well, not quite the bit that everyone wants to know about, but this is a very important message. I'll just leave this here for a few seconds from the team at Selfwealth. Rob's given me the big kind of elbow in the side to say, hey, mate, chuck this one up for a little while, would you? And there it is, a very important message from Selfwealth, the big button that says subscribe. Okay, here's the first of the most important slides of this evening that are the general advice warning or the general information warnings. We'll be talking, chances are, about ETFs. We'll be talking about investing in the share market, these types of things this evening. It's always important to understand that any of the information is strictly general financial information only. We don't know your personal circumstances, your needs, goals, or objectives. So if you do hear the information, be sure to speak to your financial planner before you have acted on this information. I'm the founder and director of the Rask Group Proprietary Limited. We are a corporate authorised representative number 1280930 of Waddle Partners AFSL 383169. You can read our financial services guide. Any company that gives this type of information out should have a financial services guide or FSG that's available on their website. Finally, the views expressed in the live streams are solely those of myself and or any guests that we have on the program and do not necessarily reflect the views or opinions of Selfwealth. And there is an extra disclaimer tonight. In fact, you've got 2 more. So I know Rob always writes into me and he sends me a very lovely picture every Wednesday morning, and he says, I cannot wait for tonight's disclaimer. It's a triple treat for him because he's got 3 disclaimers, and there's another one there from Selfwealth and another one from Betashares. So just take a look at that. Thank you very much. Okay, this month on Selfwealth Live, we're obviously featuring the Betashares plus Selfwealth mini-series. If you haven't already done so, you can go to the link in the video. So below the video that you're watching right now, you can click the link and there's a special page that you can go to there where you can just fill in some information. It takes about 20 to 30 seconds and you can go in the draw to win some prizes. And the prizes up for grabs, if I'm not mistaken, are 3 $2,000 investments in Betashares ETFs. So it's very quick and easy to put your name in the hat for that. And all you've got to do is basically pick an ETF and why you would use it for the core of your portfolio, or not just an ETF, but just ETFs in general. Like what goes into the core of your portfolio. So you can fill that in. There's a link, like I said, below the video. Be sure to check that out. We are at part 2 of this ETF mini-series. We are covering, if you're a bit worried about the economy, you're a bit worried about the market, how can you invest through it? How can you make sense of it as a first step? And I'm very pleased to welcome my guest and our guest for this evening, David Bassanese. How are you, mate?
Great to be with you, Alan.
You are joining us from Cairns, if I'm not mistaken.
Yeah, no, we are. We're up here doing a client event at the moment. So, we do travel around the country a bit, visiting financial planners and investors, and just so happens you find me today in Cairns.
Beauty, mate. I bet it's a bit warmer than where I am.
It's beautiful. The sun's just setting, actually. I'm looking out over the beautiful skyline. So, yeah.
Lucky you, mate. Lucky you. So what we would normally do is we would welcome you to the show and do all these types of things. But chances are people have heard of you or read some of your information across the internet. There's plenty of it. Maybe just a quick bio, a quick introduction to yourself. Can you tell us what it is that you do day to day and your role at Betashares?
Yeah, so I'm chief economist at Betashares. I've been here for about 8 years. I mean, my background is macroeconomics. I, worked at Macquarie and Treasury, OECD. I wrote for the Financial Review for a decade on global markets. So I love the, top-down investing, and I loved when ETFs started developing in Australia because it does allow for that sort of global, top-down type of investing, focusing on asset classes, regions, countries. And it's not about stock picking. I'm not a stock picker. There's maybe some wonderful stock pickers in the audience and in the industry, but all the thing about ETFs is you diversify away company-specific risk and you focus on broad asset classes and regions. So what do I do day to day? Basically, I monitor the economy, try to keep track of, where things are going in terms of interest rates and economic growth, asset class returns, and, provide that information through our website, through blogs, webinars, going out around the country as we're doing at the moment, giving presentations at investment seminars or to financial planners that that we work with that use our ETFs. And so it's really, trying to distill, a lot. There's a lot of information out there, often, too much information, and part of the job is to, sort the wheat from the chaff, so to speak, and find what is, what at the moment matters, and give my best assessment at least of how things may go. But that's essentially what we do. And again, at the moment we have 80 ETFs, and so there's always something interesting to invest in. Again, you can be very plain vanilla and just have a core portfolio, but if you do want to, try to be a little bit active, ETFs allow you to do that without stock picking. So you can pick a region, a country, a thematic, bonds over equities, and I try to give some guidance in terms of what I like at the moment in the markets.
Yeah, great. So one of the questions that a lot of people would have, and we're going to be talking about this obviously not just tonight but throughout this entire series, is there seems to be like a lot of noise. There's a lot of predictions from people about whether the stock market goes up or down, people searching for explanations and so forth. I'm curious, and I kind of have this idea in my mind, maybe if you can just give us a few of the things that you would look for when you're studying the economy, whether you're looking at the stock market, the property market, the bond market, whatever you're looking at, what are some of the things that people should follow? So what are the factors you consider, and how do you consider them?
Well, I mean, look, obviously in terms of the economy, the key, there's three things. There's inflation, is inflation at the moment, like the story has been, inflation has gone up post-COVID, and central banks have been jacking up rates to bring down inflation, slow the economy, bring down inflation, ideally without creating a recession. But ultimately, if you need a recession to get inflation down, that's what central banks will do. So inflation, particularly at the moment, so inflation, unemployment, and interest rates are the three key variables in the macro economy. Everything, so if the unemployment rate is obviously going up, it means growth is weakening, it's below trend, and there's, the economic outlook is weakening. And then obviously if inflation is rising, that's going to make central banks more likely to want to slow growth from wherever it may be at the moment. And then obviously just the trend in interest rates. Now, if you're looking at the share market, obviously weak growth, pace of growth affects corporate earnings. So that's a big factor in terms of the direction of the share market. But you've got two things. You've got earnings and you've got valuations. And so the other issue is, price to earnings valuations, and the equity risk premium is another sort of measure of the earnings, the earnings yield of the market less bond yield. So at the moment, for example, in the US, the share market has had a good run with the fear of recession has been easing. But we're in a situation where the valuations are pretty high. Like the market is trading at 20 times forward earnings. the so-called equity risk premium. So you take that PE ratio, you turn it upside down, you get the earnings yield of the market. You take away the bond yield at 4%, you're getting an equity risk premium in the US of 1%. And the 20-year average has been, 3.5%, 4%. So the market is it's pricing in a lot of good news basically at the moment. But the news has been good. So
Yeah.
that is the dilemma for investors, is that, the market looks expensive, but it's been pricing in good news for the past 6 months, and that good news is basically slowly being validated, or that those hopes have been validated, which we may or may not get into. But
how about here in Australia then? Is it similar?
So our market, we are similar to the US in the sense that we both have high inflation. I mean, everyone around the world has high inflation post-COVID. And so central banks apart from China, which we may get into, China's actually got negative inflation. But, the US has got 5-6% inflation, so do we. Our economy has also been doing very well. Basically, consumer spending has been strong. The big difference is that we are seeing signs of a slowing in the economy, particularly consumer spending, because our economy is more sensitive to interest rates. More people have variable rate mortgages in Australia, whereas in the US, most people have a fixed mortgage, and not only fixed, but would you believe fixed for 30 years?
Yeah.
And so the increase in rates that we've seen hasn't really slowed the US economy all that much, whereas it has started to slow the Australian economy. But the good news is that central banks are still close to finished in raising rates, because inflation has been coming down. So despite the resilience of the US economy, and even up until recently, the resilience of our economy, inflation nonetheless has been coming down.
I actually have a few hypotheticals to throw at you, David. I've got, the first one would be, I guess, imagine interest rates here in Australia, I'm referring to. Imagine interest rates here in Australia go up.
Yep.
So I don't know whether or not that's like what people expect at the moment, but if interest rates do go up here in Australia, what are the sectors or asset classes that you would expect to perform, maybe good or bad, however you want to take that, in such an environment where rates are up?
Okay, so firstly, I mean, one thing, when interest rate really often, the key question also is, it goes up for what reason? I mean, if it's going up because growth is strong, and they're going up from a low level, inflation's under control, but central banks are basically what we call renormalizing rates, like taking them back from a low level to an average level. It shouldn't be problematic for the share market. So just because rates go up doesn't mean equity markets go down. First and foremost, it's bad for bonds. Generally speaking, rising interest rates hurt returns on fixed rate bonds. But depending on the severity of the rate rises, it shouldn't necessarily weaken the share market. Though last year was a case in point, rates did go up and it hurt the share market because people were fearing growth was going to slow, and valuations were high at the time. So within the equity market, rising interest rates, I mean, again, it's hard to, there's not, look, again, if people get defensive, I mean, you'd probably, if you are fearing an economic slowdown due to rising interest rates, you'd probably go defensives, things like healthcare, consumer staples within the equity market. But that's basically bad for bonds, not necessarily bad for equities. But to the extent it is, you'd want to look at the defensive parts of the market.
Okay, let's flip that around then. Imagine interest rates start to come down from here, which is what some people may or may not be expecting right now, because we've seen such high increases. How does that, in terms of like people thinking of building portfolios through ETFs and what have you, how would that change the outlook and the positioning, so to speak?
Again, so first and foremost, if rates are going down because we're cratering into a recession, central banks have backpedaled and starting to cut rates because growth is weakening. Great news for bonds. So anytime interest rates fall is good news for bonds, irrespective of what's happening, whether it's good or bad for the share market. So that's the first thing. But if it's because we're going into recession, equities are going to be under pressure. But at the moment, I think what the outlook over the next while may well be that central banks cut rates next year because inflation is coming down, but the economy is not going into recession, and so it's actually probably going to be okay for the share market. Now, the the parts of the equity market that most benefit from falling interest rates are typically what we call growth stocks. So companies that trade on high valuations with high future earnings potential, because the present, get a little bit technical, the present value of that future earnings stream is worth more today when interest rates drop. So things like technology stocks, things like the NASDAQ in the US, for example. In Australia, we have an ATech ETF that gives you exposure to the small group of, very innovative Australian technology companies. So these are the areas that would most benefit. Listed property is another one that would benefit from falling interest rates.
I've got two more hypotheticals for you because I'm trying to allow people to see how these big picture items that they hear about in the news every day affect their core ETF portfolios, right? The second one is another really popular school of thought at the moment, and this is that maybe we're back to normal, so to speak. So back to, interest rates being flat, having some level of inflation that kind of holds interest rates steady for a few years. In that type of environment, are there particular sectors that do tend to perform better, or is it more just in effect kind of a neutral market, so to speak?
Well, I mean, if the economy is still ticking over nicely, it's good for all asset class. I mean, if bonds are steady, if interest rates are steady, like you're not going to get capital growth from bonds, but you're going to get decent income returns because interest rates will be holding at certainly a higher level than we've seen in the last few years. So you get good, okay returns from bonds, probably okay returns from equities as well. I'm just trying to, to be honest, one of the interesting things we've had, it can depend on the one key driver of the equity performance. If you go back over 30, 40 years, we've actually had competing tech booms and commodity booms. So in the late 1990s, we had a technology boom where global markets, the US market did well. Then that crashed, it became overvalued. And then we had a 10-year commodity boom where the Australian market did well, resources did well. And then that crashed, around 2013 when basically the growth in China started to slow. And then we had tech boom number two, which are what I call, and where the rise of the Googles, the Amazons, the Facebooks, and that's really been a thematic in place since the GFC. And so if you think about it, again, boiling down, it's been technology versus resources as two big competing. So if we have a period of moderate economic growth, steady interest rates, it's going to, I think one key question is going to be, are we in a commodity boom again or are we in a tech boom? I suspect we'll be in an ongoing growth sort of tech boom if inflation and interest rates remain reasonably steady. And China, we're seeing China starting to slow down. So I think a return to a commodity boom seems unlikely. So I'd be favouring the sort of the technology area, the growth areas, which unfortunately does also tend to favour global markets.
And that's a great response. Thank you. If anyone wants to submit a question, please chuck that into the comments feature here, and we'll get them across to David in a few minutes. But there's one final hypothetical that I've got for you, which is another thing that people think about a lot, and this is not just investors building core portfolios, it's also people who want to travel overseas, is the Australian dollar and how our currency might impact portfolios and how we're just impacted by the companies we invest in, the bonds we invest in, so on and so forth. So we've obviously seen a lot of, I guess, pressure on the Australian dollar, so to speak. So maybe instead of asking whether it goes up or down, what would make it
Which is a hard question. Probably one of the hardest questions in finance because the currency market is very tricky to.
I've heard this. So what would, in your opinion, cause the Australian dollar to rally from here, say, versus the US dollar?
Look, if China, at the moment, it's weakening principally because people are growing a little bit worried about the Chinese outlook. The Chinese recovery post-COVID has, I guess, been faltering. And markets have been waiting for a big, typically China then announces a big stimulus package, but they haven't so far. And there's been some disappointment about that. Now, if suddenly China, does unleash a new fiscal stimulus package, infrastructure programs for building yet more high-rise apartment blocks, then that would be bullish for the Aussie dollar. And basically, and the other thing about the Aussie, it's a global growth currency. So if global, at the moment, the Aussie dollar should be benefiting from the fact that the risks of a recession in the US are diminishing. Global growth outlook is improving, but because at the same time the Chinese outlook is weakening, we haven't benefited from it so much, and so it's weakened. So that would be a big driver if the Chinese story improves. Also, obviously, it's less important, but relative interest rates. If for some reason our economy was remarkably strong and the RBA had to keep raising interest rates, whereas everyone else was steady or cutting rates, then the interest rate differential would widen, and then some investors would be attracted to the more higher interest rates in Australia, which would tend to push up the Aussie. So there are two I think again, I think it's more likely that the China announces a stimulus package and we start to celebrate a global growth near miss on recession and growth improving than suddenly our economy remaining surprisingly strong. As I said, because we're already seeing households being affected by the increase in interest rates we've had today.
Yeah, and personally, I see a lot of businesses that are being affected by it too, like local businesses, small businesses that are already starting to feel the pinch in a big way. Harold did kind of double click on that question and said, how does the falling Australian dollar affect the share market? And I think this would maybe be the Australian share market because it's the Australian dollar. So how does that affect it?
Well, one positive of it is that all the companies that earn offshore revenue, and there's many of them, I think something like 70, I think, can't recall the exact number, but like there's more exporters on the Australian market than importers. And so net, when the Aussie dollar falls, it tends to boost corporate earnings in Australia because the Aussie dollar value of their foreign earnings goes up, subject to the hedging, but generally speaking, it's a positive. For companies like CSL, for example, big export company, massive export sales. The Australian dollar value of all their sales in the US goes up if the Aussie goes down. I guess the other secondary issue would be to what extent, if the Aussie dollar fell a lot and it required the RBA to respond by raising interest rates, then that might be a negative to the extent it pushes up inflation. But generally speaking, a weaker Aussie dollar, unless offset by interest rates going up, is a positive for growth, and it's a positive for corporate earnings. It's a positive for growth generally because, our international competitiveness improves. It's cheaper to export. It's more expensive to import. And as I said, and there's that direct valuation effect on earnings.
It's actually a great cushion, isn't it, against things that might happen globally. If I'm not mistaken, like what we saw in the global financial crisis, it actually helped us in a way because in effect, it kind of boosts our local earnings, as you were saying, and insulates us in a way. There was another question that I had for you, which was, obviously you spend a lot of your time looking at the economy and what we call a top-down approach to thinking about investing. Can you maybe talk us through, I guess, the importance of building a properly diversified core portfolio rather than say, you mentioned at the top of the show, rather than picking individual stocks, for example? I'm curious how you think about the importance of that, setting that core portfolio correctly in the first instance.
Yeah, well, I think that it's a sleep at night factor. I think ultimately you want to have a portfolio that, ideally you can sleep at night irrespective of what happens in the markets. And if you can't sleep at night because of your portfolio, then your portfolio has got too much risk in it, for example, and you can sometimes have not enough risk in it. Like if you're a relatively young investor, for example, and you've got, 50 years to retirement or whatever, you should be benefiting from the volatility of the market and being invested in the equity market, but just not getting worried about the day-to-day gyrations, because we know over the long run, shares go up. But some people can be, too conservative if they're young, and maybe some people at the other end of the age spectrum could be too risky. They're punting around. They've got all their portfolio in individual blue chip stocks and switching them around and whatnot, and often, people tend to buy and sell at exactly the wrong times. So sleep at night comes back to asset allocation. And so, very simply speaking, a low risk asset are things like cash and bonds, and a high risk asset is equities. And so you want a balance of cash, bonds, and equities that the overall volatility of your portfolio is at a level that you're comfortable with. So if you're either risk averse or maybe at the toward retirement and you can't afford to stomach a big decline in the equity market, you want to be holding more cash and bonds. That way, if the market does fall, your overall capital position is not too hurt. And more importantly, you can sleep at night and you're not going to wake up in the morning and panic and sell. Sell. You want to be able to hold that. So that's important. That's the core SAA part of your portfolio. And then, of course, many people want to have a punt. Australians love betting and whatnot. So we have seen it with many of our financial planner clients, and even in other, good investors may allocate, a portion, maybe 10% or something of their portfolio to playing the market, picking individual stocks or punting on China or tech companies. But have that as a proportion of your portfolio, for a bit of return, but mainly for a bit of fun, maybe. But have your SAA, your blend of the big asset classes at a level appropriate for your risk tolerance.
Roger did ask an interesting question. This is one that we get a lot, is are the days of kicking back and riding the passive index funds escalator behind us? Which is a great question, because over the last 30 years, 40 years, however long you want to take it, basically, just take that long-term horizon, investing in, index ETFs and these types of things has been incredibly fruitful. So I guess it's just a general question, and just curious to hear your thoughts.
Look, financial markets, generally speaking, have benefited from the decline in interest rates and inflation since the late 1980s. It's been the great moderation, as it's called. So we had a period where both equities and bonds did well. We've had a few shocks along the way, of course. But all investments have been, active managers have, it's not an active versus passive sort of thing. If we go through a rocky period over the next 5 years, for example, sure, a passive investment in the share market will have a rocky period as well. But I would, again, I'm not here to be critical of active managers, but they're going to have a rocky period as well. There's very few active managers who, outperform in rocky periods, even though, some suggest they can. But if you look at the performance, certainly on average over time, they're no better than on average, active managers don't beat the market. We know that. Evidence is irrefutable globally, and nor do they beat the market at particular times of the market. If the market's going down, generally speaking, they go down just as much. Some may not, but I don't know. It's not that the passive has had an easy ride and now it's going to get harder. It's just, I think it's going to, if it does get harder, it's going to get harder for everybody. And it comes back, whether you want to go passive or active, do you think you can find a manager can generate, alpha to cover their fees? And that's irrespective of the market conditions, because historically it hasn't really mattered.
Yeah, and like you said earlier on, it's not just like the growth of the equity market has come not just from sentiment and these types of things and interest rates. It's also companies growing as well, right? So
yeah, we've had a great period of economic growth. A few interruptions along the way, but we've had a very, and today, we have unemployment at 50-year lows. Inflation's obviously high, but I think inflation is going to come back. We are enjoying, the benefits of globalization, tech disruption, which is keeping economies, generally speaking, relatively, the fact that 70% of economies these days are services, not manufacturing, means that we don't get the stop-start growth cycles we used to get. We tend to have very long periods of expansion, like 10 years, and then there might be some credit event or something that there's some shock to the system. I mean, COVID was a shock to the system, but it was nothing to do about economics, of course. We had the GFC before that, but that was 10 years ago. And we get a few minor, I would say tremors, not earthquakes, like the European financial concerns in the mid 2010s, for example, 2013, 2014. These things come and go, but we haven't had a big global recession since 08, 09, apart from COVID.
There is one maybe final question here we'll get from RBT Cat, which send in the question of what signals can you share with us that the market, I'm presuming the stock market, has bottomed? So is that companies reporting losses? Like, is there anything that you look at in the data sets that would be an indication or indicator of that?
Look, valuations, company earnings, people focus a lot. Company earnings are the last place you want to look for a turning point in the market because it's a lagging indicator. I mean, earnings reflect, what happened in the economy 6 months ago. So if if we have an economic downturn, for example, and valuations are really cheap, like the Australian price to earnings ratio, even the US market in the GFC in late 2008, it was trading at 10 times earnings and was incredibly cheap. And other things, like if we get a period where we get more bad economic, I always look for inflection points in terms of market reactions to news. So if you get bad economic news, but the market doesn't sell off anymore, it's like, well, the bad news is priced in. And then, and you can actually start to see the market recover even in the absence of good news. So it's hard. I mean, basically, but I think, valuations are a good indicator of a market bottom. And obviously just generally that the economy may be bad, but it's not getting any worse.
No, that makes a lot of sense. It's actually really interesting. I hadn't thought about it that way. It's like the people's reaction and investors' reaction, the market's reaction to the news events and how each kind of an iteration of those news events changes. Like, is it dramatic? Is it less dramatic? Is there no impact
I'll give
at
you
all?
a quick example. You a quick example. We may run out of time. Like back in 2020, COVID, US weekly jobless claims, we knew they were going to be a huge number because everybody lost their jobs during the lockdowns, and it hit 6 million. It was 6 million people, and but everyone knew it was going to happen. And you know what? The market rallied on the day because they thought that's as bad as it gets. It can't get any worse than that. And so there's an example where it was terrible news, but it was already fully anticipated by the market and priced in. And essentially the economy did not get a lot worse from where it was at that point. It was really bad at that time, but it slowly recovered, and a market sort of sniffed that out.
We've got one final follow-up here. It's from Kumar, just a really quick one, David, which is in follow-up to RBT Cat's question. Would you look at a sector's or economy's capital investment, so what they're investing in a sector, etc., or is that a lagging indicator, so to speak?
Would you look at an economy's? Oh, you mean business investment in the economy?
Yeah.
Look, it's really, I think it's more a reflection of what's going. If the economy is doing well, businesses are going to invest. So generally speaking, business investment is not like a big lead indicator. Things that are things like housing construction can be quite cyclical, and that's a good lead indicator. These days, because consumer spending is such a big part of the economy, consumer sentiment is more of an indicator. So I think business investment tends to react to how the economy is performing rather than being a driver of the economy per se.
No, that's great. One thing that I follow closely is business confidence and these types of indicators that we get a lot. And just it's literally out there asking people and business owners, what do you think is going to happen? And that will probably inform a lot of their choices. So, David, this is the first time you and I have ever spoken. I can't believe it's taken this long, but I know you write prolifically. You spend a lot of time. I think you're on Twitter as well, or X, shall we call it these days?
What is it these days?
Who knows what it will be in 3 months? But we really do appreciate you taking some time out of your Wednesday night to come over here to Selfwealth Live and join us for part 2 of the series, mate. Much appreciated.
Good to be with you. Okay.
Thanks, David. Cheers, mate.
Bye for now.
So that was David Bassanese. Obviously, I feel like I could have spoken to him for hours, to be honest. So that was a real treat for us to have him on the show. Hopefully, I know that we will see more of the Betashares team next week and the week after for installments 3 and 4. We'll be talking with Cameron Gleeson, investment strategist, coming up. I believe it's next week it goes to air, when we'll be talking about basically what are the big themes that are remaining in the 2020s. Like, is artificial intelligence? I noticed there was a question on that just there. But I would like to take you through a bit of a different look at how you can think about investing in times of uncertainty. So David's just taken us through that top-down picture. Now let's spin it and let's look from the bottom up. And to do that, I've got a few slides with you that will help you explain help me explain how I think about it. So what I've found in my 10 or so years of doing this is that a lot of people are constantly worried. And we have this saying in the stock market that the market climbs a wall of worry. And what that effectively means is everyone is always worried, but the stock market keeps going up. So why does that happen? And the reality is there's always something to worry about, isn't there? Like right now it's inflation and interest rates and mortgages and property. Go back a couple of years, it was COVID and health and travel and all these types of things. Go back further than that, it was the European debt crisis, as David alluded to. Go back before that, it was the global financial crisis. Go back before that, it was war in the Middle East and so many other things. So there's literally always something to worry about. Yet the stock market has continued to go up. So how do we kind of reconcile this? Well, here we can see on this chart, and I've shared it with some of you before, maybe going back a year or two. And this chart originally came from Morgan Housel, and we've kind of done a variation of it. Morgan Housel being the author of the book, the fantastic book, The Psychology of Money. So when I get worried about the stock market, I tend to tune out the noise. And this chart plots basically the type of information that affects your portfolio. And so down in the bottom left corner here, we have what we call noise, like information that's not really useful. This stuff also tends to be quite common. Things like clickbait titles, gossip, so maybe things that you hear when you're around at your brother-in-law's barbecue and he tells you to go and buy Bitcoin. That might be a bit of gossip because he says, oh, did you hear that BlackRock's going to do this thing, or such and such is going to do that, or Michael Burry said this. Then we've got uninformed analysis. So this might be from people that really only understand one piece of information, like the stock market is going to fall this year. Oh yes, why is the stock market going to fall? And then they say, I don't know, that's what I heard it. And that would be an example of uninformed analysis, and so on and so forth. And basically you get up into the top right-hand corner here, and information that is actually important is incredibly rare. And this is the type of information that actually requires you to take immediate action. And I would say really the only type of information that I've ever come across that would maybe prompt me to take immediate action is when a company in my portfolio, so an individual share, releases its annual results, and those are really bad. And it's very rare that I would go and buy or sell an investment there and then. But it might confirm what I already believe. So say, for example, I had a belief that this company is maybe going to struggle for the next few years, and then it comes out with its actual results and it looks like it's struggling. But most of the time with my companies and my ETFs in my portfolio, I have a reason written down for owning them in advance. So I might have a reason for owning a particular ETF, and that might be long-term growth. I might have a reason for owning a share, and that might be that I think it's undervalued. And what I would do is I write this down so that when I do get that piece of immediate action needing, immediate news, and I have to take immediate action on it, I can think to myself, okay, does this make sense based on what my preconceived thesis was? So Simon, you've said a lot of financial content creators are riddled with clickbait titles and content. Simon, that is very true. CP, you've said, this is sort of like what's important and what's knowable. It's better to focus on what's important and then pick what's knowable. I couldn't agree more. So you have like what's important and knowable, what's not important and knowable, what's not important and not knowable. And some of the things that we focus on are simply unknowable. There's no specific answer to it, but it's also not that important. And some people get confused with these different things. So Kamayev said, wouldn't people's sentiment and follow the action create a snowball? It does. It does create a snowball. And that's where you typically have those kind of vicious cycles that we take. Roger, you've said, I would take immediate action on significant short selling activity in a company in which I have a holding. I've had to learn to do this based on not doing it previously. That's a good one, Roger. I want to bring something up. So short selling is the act of betting against a company, right? It's the act of basically taking the opposite view that a company will do well. But short sellers, what they do is they actually employ PR companies or public relations companies, and they release their results, they release their reports at exactly the time that they think the company is most vulnerable. And you can see here that this happened in 2019 with a company called WiseTech here in Australia. Now let's have a look at WiseTech's share price since then. So if you had sold at that point based on, oh no, there's a short seller coming, and then you found that the shares have fallen to $11, fast forward 4 or 5 years, it's now $84. So Roger, to your point, many companies have actually taught me that, well, actually, the way I invest, frankly, is very high growth. Like I invest in what I would say are the greatest companies. And that's literally what I look for. You can see an example of one of those here. Microsoft, I own shares in Xero, for example. And what I've learned is that if you hold a share or a company, an ETF or a company for long enough, eventually, I can talk about that CP 1 second. Eventually, if you own one of these shares or companies or ETFs for long enough, someone is going to say something negative about it. And someone is going to sound smart. For example, I own a company called ProMedicus. Some people know that already. A company that's here in Australia. And ProMedicus is one of the most expensive shares on the stock market. It seems so overvalued all the time. And for most people, it's really easy to make a negative thesis to say, well, it's overvalued, it's probably going to fall, how can it keep growing? Sounds pretty convincing. But here I am still owning the shares. Why? It's because I have my thesis, my reason for owning that investment set in advance, so that when someone comes and challenges it, I have a defense already prepared. And if they're right and my thesis is wrong, then I know that it's actually a good time to sell. So I've got, there was a question here about, good day, Brian. There was a question here from CP. Could you please talk a bit more about what aspects you cover off when writing your investment thesis? I'll do that really quickly before I get to the rest of my slides. So let's see if this comes up. So we publish at Rask, we publish our investment philosophy for everyone to see. So this is on our website, and it tells you exactly why I invest the way that I do, the principles that I believe about the stock market, and then how we actually go and do that with different ETFs and whatever. And the way I write my thesis, so the way I write up like a journal about the companies or that I'm investing in, or the research that I do, the way I write that reflects what I believe about long-term investing. So many of you will know this. I want a company with a strong competitive advantage. It has to have good management. It has to be a company that I can understand. It has to have a large growing market, and the business must have a reasonable valuation before I buy it. And so those 5 things are really important to me. So when I do my write-up and I write my thesis and I look for reasons to invest in a company or an ETF, I'm looking for this criteria. And so that's what I write down. I have a headline and it says competitive advantage. I have another headline and it says management. I have another headline and it says circle of competence, and so on and so forth. So another thing that you can do when you get worried about the stock market and someone approaching you and saying, hey, it looks like the stock market's overvalued, I think it's going to crash, is you can go back in time. And the reason that you do this is because you realize, as I said in the email today, that history doesn't repeat itself, but it does rhyme. And so when it comes to the stock market, this is a chart here from Vanguard. This shows the performance of investments, the major types of investments that people were making in 1970 all the way up till today. And you can see that on average, the stock market in Australia rose 9.5% per year. Now, if we go back 120 years, and I've shared this with you many times, this is a chart from Market Index, and I'll try and bring this up here in the middle and see if I can get that to blow up a bit. Zoom in, there we go. And here we can see the calendar year return. So from like January 1st to December 31st every year, what was the return of the stock market that year? And here you can see in green all the positive years and in red all the negative years. And you will see that on average, around about 1 in every 5 years, the stock market is negative historically. 1 in every 5 years. That means the other 80% of the time it's positive. So my philosophy with this is effectively when someone comes to me and they say, I think the stock market's going to fall, I would say, well, firstly, how did you get to that, assumption? Second of all, I think based on probability, you're wrong, because the probability says that more often than not, the stock market goes up. Not every year and not every 4 years. Like it's no exact repetition from it, but more often than not, the stock market goes up. So I find comfort in that. I can see another one here. Okay, so CP, the best time to invest is when there is blood in the streets at the height of pessimism. It can be. I'd say the best time to invest is almost always. So the third thing you can do when you start to get worried about your investment portfolio is you can consider different opinions. I've shared this on the show yet again once before. It's the story of the 6 blind priests and the elephant. So 6 blind priests approach an elephant, and obviously they can't see, so they just reach out and touch the elephant with their hand. The first priest touches the elephant on the trunk, the next priest touches the elephant on the foot, and another priest touches it on its belly, another one on its ear, so on and so forth. And they all touch different parts of the elephant. And then they're asked, what are you touching? And some people say, oh, I'm touching a seat, I'm touching a wall, I'm touching whatever, right? And each different person, each different priest touches the elephant in a different spot and says it's something else. And this is really important because when people go to the stock market, typically they find their way there through a few common channels. Number one is they find it through a friend or a family member. They say, hey, you should consider this thing called investing, and here's how I do it. So they're looking at the elephant or the stock market from the perspective of what their friend or family member gives them. The other person gets to the stock market through a trading strategy. They think, wow, this is a really cool trading strategy. I heard you can trade stocks and make money. How great is that? And that is a pretty well-trodden path that a lot of people go on, and they realize trading is actually very, very difficult. And I would say it's actually pretty much impossible, at least for individual investors. Then there are other people who read a book, like say Warren Buffett book, and they think of investing in the share market as long-term investing in undervalued companies. And finally, you might see people who, in the case I saw it in the chat before, who might have read a Jack Bogle book, the founder of Vanguard, and say, index investing, that's the best way to do it. And my point with all of this, guys, is to say to you that there's not one right way to think about investing. And the moment that you think there is the moment I think that mistakes happen and we begin to doubt ourselves. So at any point along the journey, it's important to consider other opinions, but also make sure that they're informed opinions, as we saw earlier on. I've only got 2 more slides for you, or 2 more slides. So when you get worried about your investment portfolio, which we all will from time to time, when you get worried, trust me, it pays to default to optimism. On average, not always. Obviously, as Roger was saying before, sometimes things can go wrong. The Slater and Gordon was brought into the chat before. Things can go wrong, and they go wrong, and you should get out. So there's times when that makes sense. But as we saw before, that's not that common. If you have a diversified portfolio, if you've got ETFs as your core, and you've got all of your well thought out investments around the outside, the chance of having to actually sell immediately are pretty rare. So I always default to optimism, and there are a few reasons for this. You can see on this chart here, and what does this chart show you? This chart shows you, I think it's since 1920. I think I've still got the original up here. This chart shows you that since 1928 or so, it shows you the profits of companies on the US stock exchange. So this here effectively represents how profitable the stock market is. And what you can see here is the profits of companies going up and up and up. And even when they fall, they come back and they go up and up and up and up. And the reason, there's no real magic to this, but the answer to why this happens is that companies exist to make profits. And if one company is making big profits, another company comes along to challenge those profits and grow its profits even faster. And eventually, we end up with companies on the stock exchange rotating through, but getting more and more profitable because they're solving more and more problems. And there is a famous quote, and that's the next slide I've got here. There is a famous quote that I always remember when I think about companies and investing for the long term. And it was actually said in 1889 by a guy called Charles Joule, who was the commissioner of the US Patent Office. So he was in charge of taking in all of the designs and technology that people were building in 1889 and making sure that those companies that developed and the people that developed those technologies were protected. And here's this famous quote that says, everything that can be invented has been invented. And it's a fantastic quote because it reminds us that even the most powerful people, the smartest people in the world at the time, can and often will be wrong when it comes to investing. And I often find that the people who think this way are the people who tend to do really poorly with their wealth creation. The people who do invest optimistically, the people who believe in a better future, not a worse one, are the ones who make money. And you could probably recall this from your own personal life where someone's come up to you and they said, hey, I think the stock market's going to fall. Or, hey, how bad is that thing in the news right now? Or, hey, did you hear about that horrendous thing that I saw on the Today Show or on the morning show or whatever you watch? All of that stuff doesn't really matter because typically what happens is human beings solve bigger and bigger problems. And we can see this. Like, imagine if we just we wiped our hands and we said, okay, that's it, 1889, we're done. We wouldn't have many forms of electricity. We wouldn't have cars. We wouldn't have hospitals as we know them today. We wouldn't have global trade. We wouldn't have the internet. We wouldn't have technology like we know it today. So many different things. And yet here was the smartest person, the most informed person, probably in all of America, saying that we've basically reached the peak of human nature and human, I guess, innovation. So those are some of the things that I've come up with, I guess, and they bring me lots of comfort in times of uncertainty. So now I'll just answer some questions. Please send them through. I've got a good one here from Nasia, who says, hey, Owen, do you have a view on investing via StockSpot? It's very topical right now, Nasia. It's in the news today. Maybe that's how you've discovered StockSpot. Maybe it's not. Maybe you've been in the industry for a long time or investing for a long time. So we see a lot of robo-advice businesses in Australia. So robo-advice, what does that mean? These are basically portfolios that are already created for investors, and there's really no robo at all, to be honest. The only robo element is that when you create an account with any of these platforms, effectively, you just invest in a portfolio of ETFs. Most of the time, that's what you get. And I don't really think of that as robo advice. I just think of it as like a kind of ready-made portfolio. The same way I don't call it like Robo Fresh, or I don't call it like Hello Robo when I'm getting my Hello Fresh delivered every week. Just because the box is already made for me doesn't mean that it's really as scary as it sounds. So StockSpot is often lumped in with these robo advice platforms, but basically it's just a different way to buy ETFs. And there are some good things and some bad things about that. And yeah, it's not the only provider, but it's just a way to do it. And I think we've seen a lot of different products come to market like this in recent years. Unfortunately, Six Park, which is one of the competitors to StockSpot, did close down. And obviously those investors had to look elsewhere to get their portfolios. Those Apple shares would be worthless, says Jason. Now you're commenting on what can be invented has been invested. So there was a good question here from CP. Owen, how do you judge management? And there are a lot of people judge management and people in different ways. And what I've come across in my time speaking with hundreds, if not thousands of professional investors now, is that we all tend to have an above average view of our ability to judge other people. So we all have confirmation bias, but we all have endowment bias, right? Endowment bias is this idea that mine's better than yours, even if they're exactly the same. And we tend to believe that we have a better than average chance of, judging someone's character. So I tend to think, and I will admit to this, I tend to think I have a better than average ability to judge companies, like CEOs and the management teams that run those companies. But I could be wrong. So I say that just to insert a bit of humility before I tell you what exactly I look for. So if we go back to this page, some people, when they look for management of their companies that they invest in, so say, for example, you go and invest in Apple and you want to look at the board of directors or the CEO, and you look on the website and you see Tim Cook's name. A lot of people just have this like one rule that they only look at, say, how many shares does Tim Cook own? Or what is his experience? Or where did he go to university? And I would say a lot of those things may be important, but they're not always the most important thing. So what I look for are not just the alignment. So how many shares does the CEO own in the company that I'm looking to invest in? But also, are they transparent? Like when I listen or I watch interviews with the CEO, do they seem honest? Do they seem candid? And most of them aren't 100% transparent because maybe they can't be. But most importantly, I think the most important thing, I was actually asked at one of the Rask events last night, or was it the Rask event last night in Terrelgan down here in Victoria. I was asked a question, what's the number one thing you look for in any investment? And my answer is who's running the thing. Doesn't matter if it's an ETF or a local cafe. I look for people who are considering themselves as owner-operators. And I'll give you the perfect example. Imagine tomorrow morning, you wake up, it's Thursday morning, and you go down to the local bakery thinking, I'm going to get something baked. It's going to be either, a beautiful egg and bacon roll or a piece of bread, and I'm going to go down there tomorrow. Now, I want you to imagine that when you step your foot into the local bakery, that you have the potential to be served by two different people. The first person who could serve you is the owner of the bakery. This is the person who started the business, runs the business, and sees you come in and greets you. The second person who could serve you is the young person who is just a contractor and they work, 4 hours a week. I want you to imagine who would give you the better service. I would almost be willing to bet my house that the person who runs the business will give you better service. Maybe not always, but on average, I would take the business owner first. And the reason I do that is because they care. They genuinely care about the service that the customer gets, about the way that croissant is presented, and about how they tell you about what they're doing, because they care. And I think a lot of investors in the stock market just forget that really simple thing. Does the person who runs this investment that I'm trying to make actually care? And there are so many elements that come with that. But if you identify someone who is truly passionate, honest, transparent, and has the energy and motivation to make it work, more often than not, I would say that those are people that I'm willing to back. It doesn't matter if it's a huge company or a little company. And that's just a thing. I can see Stuart says the same thing, and Tapan says the same thing. Stuart says, I always look at the directors and their track record first. Yeah. And this is a really simple thing. You can just Google the person's name and look for interviews, and then you can look back at what they've done in the past. I think that's a really important trigger there, Stuart, is a lot of people sound genuine and a lot of people sound like they're doing the right thing by you, but really they're just serving themselves. And so the way to test for that is to Google that person's name and look at what they've done, and then go to their LinkedIn profile or look at where they were before and what did they do. So if they were a CEO at a previous company and that company is on the stock exchange, you can find out, did that company go on to be a success or was it a failure? And you try and drill into that. Like I've had instances where we've gone to invest in companies, and I remember seeing this one company where the CEO had actually had two companies before that both went bankrupt. One of them was on the stock exchange, and 6 months before it went bankrupt, was saying how this thing is wonderful and this, that, and the other, and then it went bankrupt. And the other one was a private company that went bankrupt. So that was an instant. We actually still proceeded to catch up with the CEO and have an interview with him just to try and understand what had happened in the past and had maybe his strategies changed, but we decided against making that decision. So, it's a good question, Kumar. Maybe this is the final one. I think you spoke somewhere that promoter managed better than professionally managed. There is a heart with promoter managed. So Kumar, yeah. So, what I look for when I invest in fund managers, which is a little bit different, I'll answer this through that lens. When I look for fund managers to invest with, what I'm looking for are a few different ingredients. The first is intellectual honesty. This might sound quite odd, But what a lot of the investment industry and the finance industry is designed to do is to make you feel confident. So if you were to walk into me, and I'm one of these people that I'm going to wave the red flag for, you walk into me and I'm a professional investor and I say, Kumar, you say, Owen, I'd love for you to invest my money for you. I've got a great idea for you, Kumar. I'm going to go and invest your money down here. We're going to go down there and you should see these stocks that I've picked and they're great. And you walk away feeling really confident. Geez, well, Owen really knows what he's doing. I do not look for that. I deliberately look for the opposite of that. I look for an investor who is intellectually humble, because just having that kind of overconfidence, I think, is a very big risk when it comes to picking fund managers to invest with. And there are other things that I look for, like, does the person who runs this fund or runs this company invest in the company or in the fund itself? Does the ETF manager actually invest in ETFs? Like, it's pretty straightforward. It's not always the perfect one, but it's a good one. Glenn, you've said, this is a great comment, Glenn. Thank you for sending this in. There is a great book called Just Keep Buying by Nick Maggiulli. I love his book. Yeah, so I'll call this out as the final thing. So Nick Maggiulli, we actually did an interview with Nick Maggiulli not too long ago, Glenn. It was a fantastic conversation with Nick here when he brought his book out, and he's a data scientist. And he basically, like, if you read the title, you get an understanding of the book. Just Keep Buying. This guy's a very, very accomplished data, I guess, scientist, or like I guess it's not econometrics, but it's kind of like, how does the data inform people's decision making with investing? And he's done such a fantastic job of just saying the title, Just Keep Buying. So Jason, you said not all CEOs of public companies are able to be gauged on the companies they ran. Solomon Trujillo, I think it's pronounced, is a great example of that. So agreed, Jason. So some, like, I think, yeah, okay. I've got a lot of opinions on this. I'll spare you the details, but I'll say this is, I love when people start businesses to solve problems, and we should invest with them and we should support them. But just because someone is fantastic at starting a business and running an organization and solving problems for the world does not entitle them, he or she, to have opinions on so many different things in life. And we tend to say that the wealthiest people have the biggest say on certain topics, when it's not necessarily the case that they should be heard. So what I mean to say is, just because someone did something really impressive in the past does not necessarily mean that they're going to do it again in the future. But the reason why we look at the past is because we're looking for those red flags. We're effectively looking for reasons not to trust what this person is saying. Not necessarily going to say, well, he worked at PayPal, therefore Tesla's a good investment, kind of thing. We're not looking for that. I'm not looking for that anyway. We're just looking for just evidence that this person has the ability to do what they say. I guess a good saying that I heard many years ago from a guy called Storm McGrath, who's a CEO here in Australia. He said that good ideas are cheap, good execution is extremely expensive, meaning that everyone has a good idea. Like, let's just go to the football on the weekend and hear how many people have an opinion on what the player should or shouldn't do, or what the coach has or hasn't done. And then you look at yourself and you go, well, you look at them and you go, well, you're not out there, you're not doing it. And that's because the people who actually do the things are paid the most for a reason, whereas the opinions are very cheap. So final comment that I'll leave you on before we come back next week for Selfwealth Live. Don't forget, we will have another Betashares installment next week. The 4 most expensive words in the English language are, this time it's different. And that's by Sir John Templeton. And you can go back in history and you can find where everyone said the stock market's about to crash, the stock market's about to go up, the property market's about to crash. Everyone says this time it's different. Because I would say, if you come to me and said, I think the stock market's about to crash, and I'd say, yeah, but it might crash, but it will probably keep going up over the long term. And you might say to me, yeah, but this time it's different. And that's where things start to get a bit funny. So I often default to trusting the data there a bit more. But this is a great comment from Sir John Templeton. And what we see is we see not repetition, as I said before, but we see recurrences or rhyming of people's tendencies through time. And that's how we can use the stock market to our example, to our benefit. So thank you, everyone. Next week's live show is going to be a little bit different. We'll be joined by Cameron Gleason. Now, I have to insert a full warning. The next week's live show will actually be a replay of a chat that's Cameron and I are having. So I've got a whole stack of questions for Cameron, and I've already sent them to him, and I'll be recording an episode with him later this week, which will replay next week. And the reason is that I'll be on the road in Queensland next week for some events. So I won't, unfortunately, be live with you here on Selfwealth Live, but maybe I will be live with you in person instead, which will be great. One final thing before we head off tonight, and that is, of course, go Matildas. 8 p.m. tonight. Tune in. The Matildas are playing. Check it out. Even if you're not into soccer, maybe we get a national public holiday, good or bad. Get behind the girls and let's see them win. RBT Cat, I can see you've said it there. You've beat me to it. Up the Tildas, says Rob. We are hopefully going to get a big fat W tonight, a big win, and push us through even closer to the World Cup. So you've got time, as Rob said, to get dinner, or in my case, get home, get some dinner, get ready, get in front of the TV and watch the Matildas. We'll be back next week. Don't forget there's a link in the below the video to enter the competition. Betashares and Selfwealth giveaway. Prizes up for grabs. Get in there. See you in Townsville, Caroline. I will see you in Townsville, and I'm so excited for that. Bye for now. We'll see you next week.